Okay, good afternoon, guys. Welcome to this webinar this afternoon. I'm going to be talking about an introduction to channel trading. So if everyone's here, I think we'll just begin. Okay, before I start, as always, I need to read a risk warning. Now, spread betting and CFD trading both carry a high level of risk to your capital with the possibility of losing more than your initial investments. Please ensure that you fully aware the risks involved and, if necessary, seek independent financial advice. Again, the views and comments during this presentation are not the views of intertrade.com. The provision of this information should not be construed under any circumstances or recommendations to solicit or to buy or sell any security or financial instrument herein mentioned. Intertrade.com assumes no responsibility for your trading results. Okay, so when we talk about trading channels, what we're looking at is that it's an observation based on the tendency that many financial instruments tend to move in a set direction and maintain this for a period of time. Okay, so a channel really defines when an instrument's price is confined between an upper and a lower parallel band. Okay, so the lower line is obviously our level of support, and the upper line is considered as our levels of resistance. So very much as we trade our horizontal lines for where we see support and resistance within the market, what trend channels try and do is try and understand if the market's got an upward bias, a downward bias, or a sideways movement, and that it should move between two fixed points or two fixed points of support and resistance. So again, when we identify if the market is moving in a bullish momentum or a bearish momentum, we can trade in this direction. So we buy on the levels of support and we can sell the levels of resistance. So we have three main types of channels. Okay, so we have our ascending. So that's when the price action exhibits a positive slope with rising tops and rising bottoms. So again, that's a bullish movement when there's more buyers in the market than there are sellers. Then we have our descending. So that's when the price exhibits a negative slope. Okay, so that's just a bullish movement. So again, the moves we're seeing in the stocks at the minute, the stocks are moving lower. So that's a bearish movement. Then we have sideways. So again, this is where trend channels really kind of come into their own, when the market really doesn't have a bias and you can't pick out of a market looking to move up or looking to move down. It's just moving in a wave fashion. That's what we call sideways. Okay, so what trend channels are really useful for is when a market doesn't have any real direction. You can put, generally speaking, a trend channel in and find the highs and the lows, and we can trade within this particular channel to make money. So it doesn't matter if the market's going up or the market's going down. As long as we know the fixed points in which the market tends to move, we can then trade accordingly. And then we don't have to have a bullish or bearish bias. We're just trading in the middle of this range. So the types of channels, again, we have diverging sideways. Okay, so this is best described as a combination of rising tops and falling bottoms, such as the price action diverges, yet the overall pivot remains roughly the same. Okay, so simply put, that's when, again, the market just moves between two fixed points and it looks for equilibrium. It just looks to get and find value when it bounces off these levels of support and resistance. Then horizontal, this is when support and resistance bands are parallel with each other, but minimal, or there's no minimal or real visible slope. And then there's consolidation. Okay, that's a combination of falling tops and rising bottoms, such as the price action converges towards the pivot. Again, an equilibrium might be achieved momentarily. So it's a lot easier to kind of look at this in a graphical format. So again, this is a bit of a sideways movement, really. Okay, we see at the beginning of the graph, the market sells off, see some little bear flags, etc., and the market waves back up. But then when the market consolidates, we can draw in, again, our two levels. And again, when you talk about putting in any kind of levels, you can draw these in freehand. They don't have to be always exact. Remember, when we're talking about the markets and trading against other people, then we're talking about the self-fulfilling prophecy. So if the levels that you put in are most likely to type with the levels other people put in, then that makes them self-fulfilling. So you don't have to be too complex with your levels. You don't have to be too precise. Just put them in where you can identify where the market turns, where we do find our levels of support, our levels of resistance. So in this particular example, we can see that we've drawn our level of resistance at the top and level of support. It does break down and break above these levels, but only for a brief amount of time. Again, when we see in the middle, we see an island formation here, and the market sells back down. We see some tweezer tops and the market moves back into this range. So what we do is that we know the market doesn't have any real direction at this point. It's not particularly a buying bias or a selling bias. So what we do is when the candles give us these formation patterns, like we see just here, where we can see like some indecision come into the market, and sorry, 1 second. So when we see some indecision come into the market around the top end of resistance, yeah, and then the market then comes back in to find the midpoint, to find the lower levels of support, and we see a nice big red candle print. So again, when we don't have any direction on any kind of particular bias in the market, it doesn't mean we can't trade. It doesn't mean we can't make money. But what we need to do is put in our two parallel lines, yeah, and then identify when we break back into them, that's a good point, yeah, to look for equilibrium or to look for the lower end. So we sell the points of resistance and then buy the points of support. It's as simple as that when you're looking at trend trading. Okay, so we can use it again in an example of an uptrend. So what we've identified at this point is the market has a buying emphasis, and we can see that we just again draw our parallel lines in, but this time they're more of a 45-degree angle. So again, we know that there's more buyers likely to go into the market than there are sellers. So anywhere along this bottom line, we look to buy. So again, this is where you've got to put your strategy into place. Okay, so if we know it's an uptrend and there's more buyers than there are sellers, then what we need to do with identify this uptrend is not be greedy. We need to identify when the market breaks back into value above the levels of support, and that's when we buy. Okay, we don't look to sell into the strength. The only reason we should sell is to be getting out of our long positions. And this is a common mistake traders make, that when they've identified a trend, they think they can make money both ways. Now, it's not to say you can't, okay? But in my experience, that when you're going with the trend and you're going with the overall market sentiment, it's always good to have a bias and then do what the market's telling you. So if we know the market is bullish, we know that there are more buyers than sellers, then we look for points of weakness anywhere along our level of support or anywhere where we break back in, and we buy. We buy and we hold. We look for the midpoint to be hit, and maybe we can either scale out of the position, lock in some profit, or even be more aggressive. If we still have a bullish opinion, then we double up our position and we can scale in, so positively average, and take a bigger position at the midpoint, because we know the likelihood is we're going to look to try and hit our levels of resistance on the top. So again, it's all about marrying these trend channels and this style of trading in with your risk reward, in with your style of trading. Okay, so what you don't want to do, again, is try and go against the market and be too greedy. So if you know it's buying, you know the market's going up, then look for the low points, yeah, look for the midpoint to be hit, and if you've still got the same view, then double up your position and be more aggressive. But what you shouldn't really do is try and do that and then turn and reverse and sell into this trend. Yeah, because that's when you can get caught out. Because again, if it's a bullish market and we do break through the level of resistance, you can get caught with a nasty offside position. There's no real way of knowing where the market could stop. Okay, so again, it's just all about marrying this in with your style of trading and your attitude to risk. So plotting a channel. So the first and most common way is just drawing our parallel lines. So as I said, you can use your naked eye. Okay, so you just want to touch as many points as possible. So it's very much like a trend line. Okay, I think the basic rule of thumb for a trend line to be accepted is it needs to touch 2 points. Okay, and I agree with that. But you're not always going to get a perfect trend line. You're not always where support and resistance hasn't broke through at all. It's very rare that you see that. So again, in my experience and years of charting and teaching people this, it's just look for what you look and plot the lines you think look right. Okay, it doesn't really matter if you see some breakouts, and it doesn't matter if they don't touch perfectly. As long as they touch 2 points, it's valid. And other people and other traders are going to be putting in their levels this way. So that's what you need to be doing. You need to be plotting your lines, your levels of support and resistance in tune with what other people are looking at. And that's what's so powerful about trading. For a long time, when I was a beginner trader, I thought I was a counter trend trader. I didn't have to go with what everyone else was doing. I could make money in a special new magic way, and it just doesn't happen. Okay, I was successful for the first couple of weeks, and then for the next 3 months, I lost money. And until someone who was a lot more experienced and wiser, went through my trades and taught me some different angles. And he said, "It sounds cliche, Steve, but the trend is your friend." And it isn't just that. when you're going with the trend, you're going with other traders, you're going with momentum, you're going with the market volatility. It just makes common sense. Then after that, the rest is history. But again, it's just trying not to overcomplicate your charts. It's something that people like to do. People like to have things that are finite, that are absolute. This is level of support. It can't be broken for this, and this reason. That isn't trading. With trading, the rules are meant to be broken. So you always need to constantly adapt, reassess. So again, when I say join in these particular channels or in your trend lines, just put in whatever works for you. Whatever looks right to you, it means it probably is right. Whatever you're comfortable with. So it's, again, there are more scientific matters that we can do, and we're going to go through them in a minute. We can use linear regressions to plot the pivot point and build the channels around that. But again, in my personal experience, the best way to plot any kind of level or any kind of channel is just to use your naked eye. But if you want to use other methods, then we can plot channels in these three ways. Okay, so we've got standard deviation channel, the standard error channel, and the RAFF channel. Okay, so the definition of the standard deviation channel is when two lines can form a standard deviation channel if they're parallel to the linear regression of the trend line. Okay, so they're usually set to two standard deviations either side of the regression line. Okay, sounds a bit complicated. We'll just show it on a graph in the next slide, and it's not. Then we've got the standard error channel. Okay, so the standard error channel can also be used in place of the standard deviation. It's preferred by some investors, and it's just mathematical. It's the deviation divided by the square root of the sample size. So again, it's just very much like Fibonacci, very much like Elliott's wave. It's just a mathematical representation of how the market's moving. That's all these things are. Nothing more complicated than that. Then we've got the RAFF channel, and that's the distance between the channel lines and the regression line. And it's the greatest distance that any one closing price is from the regression line. Okay, so again, just another formula based on the movement of the time period that we're looking at. So if we look at that on a graph, then we can see that the line in the middle is our midpoint. Okay, so then we've got the red line showing our standard error, which works quite nicely. Then we've got the green line, the RAFF channel, and the blue line's our standard deviation. So what we're looking for here is that the standard deviation is a little bit too far out of the market, so that can give us overall direction if the market breaks out where we could go to. But we're looking at our standard error is working quite well. So again, when we see the red line on the top, our level of resistance, we see 2 points where it's hit quite nicely, and then we come straight back to our midpoint and break back down to our level of support. Then in the middle, again, we break through very momentarily, but then the market sells back down. So again, when you put these particular channels in, again, the market is bullish in this instance. We're going from the low side on the left to the high side on the right. So we need to be looking to buy above our levels of support. When we hit the blue line, our midpoint, we either look for a bounce to take profit or a breakthrough to maybe add to our position and positively average. Okay, so that's what we need to look at. So we can look to the RAF channel for breakouts and where the market could extend to. And we can look at the standard deviation as another support of that. But again, if I was drawing these lines in after I put my midpoint in, I'd put, again, my lines pretty much where the standard error channel has worked it out to be. So again, that's what we do. We just put it into perspective of where the market could range to. And what we can use as well is our other horizontal lines, maybe Fibonacci retracements. And again, it all depends on your entry point techniques. Okay? All right, I'm just getting a couple of questions, so I'll just answer these first. Amit's asking if I can tell him about the euro dollar. I'm not quite sure what you'd like to know, but if you elaborate, I can help you. Okay, and Van's asking, is there any standard tool which draws 3 sets of parallel lines in MT4? Yes, there are. If you just look through your studies, there will be a standard error and the RF channel and the standard deviation. If you just click in and put the sample size of the data you want to do, it should draw these lines in for you. So again, it's just based on a mathematical formula, spread along whatever time period you're looking at. So I'm not entirely sure how it works in MT4, but again, let me have a look at that MT4, and I'll send a follow-up email and tell you guys how to do all this stuff, because it is fairly simple. It's just another study that you overlay on your charts. It's no more difficult than that. Okay, so building a channel trading strategy. Okay, so instead of using offer-sell strategies for channel trading, we can provide the ingredients that we require to build our own customized channel trading strategy. And this all revolves around these elements. So it's just like any style of trading. We need to time our entry. Again, the entry point is so absolutely critical with the volatility in the markets at the minute. And again, with the markets being so thin, we can easily get stopped out of position. So timing is very, very important. The exit, where we exit the trade, obviously that's where we take our profit or where we stop ourselves out. Then capital management, how much we're actually physically utilizing for this particular trade, and our stops and our limits. So entry, okay? So trading with the trend is considered, as I've just said, the safest method, because again, you're going with the momentum, you're going with the market, and generally if you're doing something right and the market's doing something in your favor, then again, it's going to be an easier trade, you're going to go onside further, and it's going to be that you're following momentum rather than trying to fight it, okay? So even when a channel is broken, yeah, breakdowns or outs do have a tendency to recover, at least to the bottom and the top of the channel, respectively. So again, once these channels are broken, doesn't mean they don't still act as support and resistance or points of attraction. So it's always worthwhile having these trend lines and trend channels drawn in your graphs, because they're always going to be relevant. As we've seen in previous presentations that I've held, that when support or resistance is broken, they do then swap places. Okay, so when support is broken, it can become a level of resistance when the market looks to move back up, and vice versa. So again, another option is decide to trade both ways. So short on a breakout from the upper band, or long on a breakdown from the bottom bands. So as I said to you before, this is a dangerous strategy to trade. Well, it's not, you see. Okay, I don't want to contradict myself here, but if you have already identified the trend and the channel, then that's what you go with. But there's not to say that markets won't break out of these channels. They will, invariably they will. But what you have to decide is if you want to be a trader that's going with the trend and going with that particular study. So you want to be a kind of a channel trader, because that's the most opportunities you're going to have. You probably get 6 or 7 trades in that trend channel where you're going to make one winner after winner, and then it'll break out, and then you might have to take a loser. But you can trade that in the opposite way. You can look for the trend channels to be broken, and then you go in with momentum and you go in with the direction of the market. Now, obviously, it won't break out as many times as it holds, or else there wouldn't be any trend channels or trend lines. So you have to decide what kind of trader you want to be. Okay, so that's another way that you have to adapt your strategy and adapt your trading style to the market conditions. Because if the market looks like it's very jittery and could break out, then today you're going to be a breakout trader. If it looks like it's going to consolidate and the market's fairly stable, then you're going to be a trend trader. You're going to go with the channel. So it's another important lesson that everyone has to learn as a trader, that it's great to have a strategy and your rules in place, but you have to know when to adapt it. You have to know when the market's changing, when the conditions are not going to suit the style of trading that you've adopted. And once you've mastered that, yeah, so you're going to be a very, very powerful trader. Trust me. Because going with your convictions and going with your right and letting level hold and come back into the channel is great. But then identifying when the market is a little bit volatile and could break out, that's even more exciting. That's when you're going with the breakout and you're catching people that are wrong, and markets can quickly spike, and you can make a good amount of money very, very quickly by identifying that people are wrong, scrambling to get out of positions, and then you're going and taking advantage of that move. But again, the breakouts won't happen as often as the markets consolidate and hold. So what we can do is, again, use this as an example. We've plotted our charts, and we know that this is a bullish move, okay? So the market's moving from the low side on the left to the high side on the right. So what we're going to do is we're going to tie this in with another oscillator, in this instance, MACD. So again, another strength indicator, really kind of trying to tell us when the market's looking to break up or down, and where the momentum's going to be. So what we're looking at is, again, anywhere on the low side, because we're in a bullish move, to start buying. Okay, so what we see is that when these blue bars move away, that we're going to look for areas to go long, yeah, and the market to tell us that we're right, to break into this channel or to continue within the channel and to hit the upside, our levels of resistance for our exit. So again, we see on the MACD, it's showing that we're looking for a good indication that the market is looking to move up. And again, we see our bottom here, which is, again, it has broke through the trend channel. But what we look to do is look to buy it when it breaks into our channel. That's a good trade. Yeah, it doesn't reach our point of resistance, but we've got all that distance in which to take our profit. So again, look at another example. Oh, sorry. I just seem to have skipped on there a minute. Okay. So again, we see that the MACD indicating that we're seeing strength back into the market. A good place to go long. All that position to take some profit. And again, it works again. So that's 4 instances where the market hasn't broke out on the low side or the upside. And we're just looking for them low points because we know the market is looking to move higher and the buyers are looking for cheapness, they're looking for value. So when we buy anywhere along that line, when the market breaks back into that channel, we've got all that direction, all that momentum wherein to take our profit. So again, it all depends how you want to manage your trade and how, if you want to positively average or you want to lock in some profit. But it's just showing you that when you tie these, again, you tie a quite simple chart and simple method of trading in, it becomes second nature. So we know that we've identified this level of support on the bottom, that if it doesn't break through with any great force, the likelihood is that it's going to move back into value, which is our trend channel. So we look to buy low, yeah, and sell high. It's as simple as that. We can tie that in with our RSI, our MACD for other indicators to help home our entry point. And again, it all depends what time scales you're looking at. So you might have to hold these trades for, I don't know, maybe 5 or 6 candles. So if you're trading off 10, yeah, that could be holding your trade for an hour at a time. But again, the more candles that print within this particular trend and trend channel, then the more it is affirming that you're right. So every time you see a green candle printed, that's more profit. So that's what you look for. Then you look for your candlestick formations, or you look for the upper levels of resistance to be hit. And until that point, you don't get out the trade. You stay long. You've already identified that you're right, it's a bullish market. You've already identified your entry point because it's low on your levels of support. And you've already identified that it should go somewhere near your level of resistance at some point because that's where it's aiming to go. So that's 3 points telling you you're right. So why would you get out the trade until until the market turns or tells you wrong? So it becomes very, very powerful in that respect. And again, for a confidence exercise, that when you've identified these channels, you've identified it's a bullish move, then, again, you can hold your trades a lot longer, which in these volatile markets is very difficult to do. And it's a lot easier to say it than do it. We all know where the market generally is going to go, but then it's the noise in between that gets us out of our trades, that changes our confidence, that gets us to put stops in when we really don't want to put them in. Yeah, that's the market psychology. And we've identified that the market's going up. We know where value is, and we know where the market looks for the exit or the change. Yeah, then we trade in between that. So that makes it a very, very powerful strategy. Okay, so your exit point. So when trading channel breakouts, you've several potential exit points. Okay, so you've got the channel recovery. That's when the price either falls or climbs back into the channel. You've got your pivot line. So again, pay extra attention to the pivot line, especially when trading against the trend. Opposite boundary. So again, if you've reached this point, you should be deep into profit. So it's probably time to play safe and either lock in some profit or see if there is an actual breakout where you can ride the trade even further. Okay, just got a couple of questions, so I'll just answer these. When the market is ranging, is it still applicable to trade within channel? Of course. That's exactly the point I mentioned towards the beginning of this particular webinar, that channels are particularly good when the markets have no direction. So when the markets are ranging and we're just moving between 2 particular points, then that's really good. At least we know an exit point and an entry point in a market where we don't have any particular bias. So yes, very, very applicable to trade channels when the markets are ranging. Okay, do I have a favorite time frame for trading channels? Well, again, as per most of my webinars, I look at 15-minute charts generally. So again, I'll look at my dailies for levels. I'll probably move down to my hourlies for key levels, but I'll trade anywhere between 5-minute candles and 15-minute candles for my entry points. So that's what I'd recommend. But then if you're looking for your channel, remember the longer the time frame, the more valid it is. So if you're trading an hourly trend channel, then again it's going to be more valid than a 5-minute channel. That's just the same with any principle of trading. But great questions, brilliant. Thanks for that, Harley. Okay, on a diagonal trend line, I've noticed support becomes resistance, resistance becomes support. I don't know any reason for this. Well, it's just the basic principles of trading, Bookie. Again, as we know, trends are there to be broken, and trend lines are there, as points of attraction. So when they break through, it doesn't mean they're not still valid. They are a point of attraction. People within the market have noted that level as a point of interest for a reason. So even when it breaks, say it breaks on the upside, when the market comes back down, the first thing it looks for is where it broke out from. So that's where, support equals resistance. So it's just the same principle with the trend channels. So when it breaks through, a level of support and resistance, the next point it looks to come back to is the point that it broke through. So that's, again, the basic principles of trading. Support does equal resistance, or can. It's not always the case, but in a lot of cases it is. So entry and exit styles. So as I've talked to you before about scaling in and scaling out, the trading kind of terminology is positive averaging and negative averaging. So that just means adding to your position when you're onside in profit or when you're offside and you're losing money. Okay, so it's just a different way of trading. So scaling in. So when you're using this method, you'd usually divide your overall instrument into 3 brackets. So 1/3 when opening the trade, your second would usually go after the price is recovered back into the channel. Then your third would be once the price has crossed the pivot line or it's going in the general direction and you've confirmed that you're on the right side of the trade. Okay, so then you exit with your full position, the first sign of reversal, or we're hitting the opposite boundaries of the channel. Okay, then scaling out. When using this method, a trader would place his entire stake on an opening trade and then reduce the exposure as the market moves in his direction, so locking in more and more profit. So again, that's just 2 different ways in which we can trade within these channels. So again, the way I would always trade channels, especially now when the markets are very volatile and move very, very quickly, I'd always trade a little bit smaller size than I need to. So even if the market pushes against me and I still think I'm right, I can then add into my position negatively. Then when the position does go on side and is going in my direction, I'd even double up that position. So again, you've taken your position over a number of prices to average it out, to kind of counterbalance the noise in the market and the volatility. So that's another tip of how to trade in volatile markets, is trade smaller size and then build your position around maybe 5, 10 prices. So you're not going to get caught up in the noise. They're not going to get stopped out. You're building a smaller position into a bigger position as you ride. Okay? So it's easier said than done, and you can perhaps play around with it. If you've got any demo accounts, maybe try that. Because again, if you're finding you get stopped out too often in trades, then it's probably because you're trading too big a size than you're comfortable with. So if you trade smaller size, you've got more options. Okay, you can build up bigger positions as the market moves. Okay, is the pivot in the center? Yeah, the pivot points, again, you can get a pivot point calculator. Very, very simple. It just takes the high and the low of the previous day, and it gives you a pivot point in the middle where the market should tip. Then 3 levels, your resistance 1, 2, and 3, your support 1, 2, and 3. Just Google pivot calculator, and you'll be able to see what I mean. So again, just take this example of an exit style with this particular chart. So we see our entry point. Again, we've identified that it's a bullish move. There's more buyers than sellers. Okay, Bookie, you mean in channels? Right, let me think about that. Well, you can just calculate the pivot point yourself. Just take the difference between the support and resistance and just draw a midpoint. So again, you can draw that freehand or you can calculate it. So that's how you do that. So again, we've identified this bullish market, so there's more buyers than sellers. So we've drawn our level of support. Again, it's not great at the beginning. We do see some breakthroughs, but when it breaks back into the channel, it's reaffirmed that the market's moving up between these 2 points. And then we have our level of resistance. Again, earlier on in the graph, we see a breakthrough, but generally when the market moves back in, we find value and it looks towards the midpoint and the level of support. So again, what we do, if this was the perfect trade, that our entry point would be here, where the blue line is, then we look for the market to break up to our midpoint. So we've drawn our midpoint in. And again, what we could do at this point, and depending on what style of trader we are, we can either increase our position or take some profit. Now, again, I'm quite an aggressive trader. I know A, that the market's going to move up because we've identified the trend. B, I'm already in profit because I've held my position on side to the midpoint. So what I'd do is I'd double up. I'd increase my position because the likelihood is, the trading probability is that we're going to break through that level, that midpoint level, and then look to hit our upper regions of resistance. Perfect trade. So again, you might have to wait for these perfect trades to come along, but wouldn't you like to trade this way maybe once a week and make the same amount of money than you would by doing little trades, by not knowing A, where the great point of entry is because you've identified it, B, going with momentum because you're going with the trend and you've identified it, and then C, knowing where the market could go to because you've got your upper level of resistance. It just makes perfect sense as a way of trading. It's not always going to work. You're not always going to do a trend channel, and you're not always going to be able to get the right entry and exit point. But if we identify this, okay, and we take a sit back, what we can do is eliminate bad trades. Okay, we don't go against the trend channel when it's working for us. Okay, so capital management. So the general rule of thumb when you're talking about any kind of risk-reward strategy is generally roundabout commit only 1 to 2% of your capital on a single trade. So again, you can read any kind of studies you want. You can search this stuff on the internet. That's what the standard people say. I don't care what standard people say, okay? I'm a professional trader. I've traded for years. If you want to commit 10, 15, 20% of your capital on one trade, you can. You're the trader. What I like about this particular strategy in trading within the trend channels is that if I'm right and I've identified the channel, as I've said, I'm on side towards the midpoint is, why don't I buy even more? Why don't I put 5, 10%? Why don't I triple my position? Because the likelihood is I'm already on side, so I'm only playing with profit. And again, I've already identified that we're at the midpoint, and the most likely trade is that people are going to get long from here as well. So why wouldn't you use more of your capital when you're on side? But again, this is just the way I trade. This is the way I see the market. When I'm right, I generally like to be more aggressive and know I'm right, to play with profit, to make even more. But again, everyone's got their own different style. I don't trade that often. So when I do identify the trend channel and I do know what the market's likely to do, then I'll use more of my capital on that trade. Generally, when people use 1 or 2% of the capital because they're scared of losing. Well, maybe you haven't seen any good indicators. Maybe you're not that confident, so you're only really trading 1 or 2% because it's safe. Well, I trade to make money, no other reason. So I like to put more on when I've identified a good signal and a good trade and go with that, and then not trade the noise, not try and get involved when other people aren't sure what the market's going to do. And that's what this particular strategy can give you. You might have to wait a day or two or a week for this channel to kind of, to give you the perfect entry point. But when you do, you hit it, and you make a week's money just off that. Okay, so Fernando's asking, do you in fact risk 20% of your capital on any one trade? I've risked 100% of my capital on one trade. But again, I'm a different style of trader than most people. Again, I teach trading in the way it needs to be taught for everyone to understand it. I don't teach my particular trading style because I can't. It just isn't possible. But when you've traded as long as I have, then I make my own rules. But it doesn't detract from the fact that I know how to trade and I've learned how to trade in a set way, and that's what I bring to these seminars. A real controlled way of trading that you can build up, and then when you do have a big account and you do have your own ideas and styles, you can adopt them into the market. I'm not to say you have to do it all the time. I do all right, Fernando. Yeah, I'm fine. I mean, you can follow my trades on eToro. So when I close out, they get posted to Facebook, so you'll be able to see. So it's working out fine for me. But as we always say, when you do trade big, you will take big drawdowns. But I'm prepared for that. That's fine. But again, I trade in a very controlled manner. So I may only trade once a week, once every 3 or 4 weeks. When I see it, I hit it hard. And if I'm right, I take a big profit. If I'm wrong, I take a hit. But that's just the way I choose to trade. If you're trading every single day and you're an intraday trader, then you have to be much more reserved. You have to stick to the rules of committing 1 or 2% of your capital to a single trade, because that's sensible. That's prudent. Okay? That's how you trade. So all these seminars I hold and all these things that I teach you are all from bitter experience, that when I didn't get it right, yeah, I lost money. But if you do things in a structured way, and in this particular way, you're more likely to trade with the probabilities to make money. Yeah, exactly. But it's knowing when to pick these points, guys. I mean, that's the real art of trading. You're not always going to get it right, but it's putting your money where your mouth is when you've done the analysis and you've got the direction of the market right. Okay, when you're just trading every single day, you have to take all the emotion out of it and just trade the figures. Trade what the market gives you. Okay. Right. Let's get back to a bit of a tangent there. Let's get back on this. So, okay. So when we're talking about an example, let's assume one decides to open a long position on the US dollar cross versus the Japanese yen and the British pound. Both Britain and Japan are net importers of commodities and therefore susceptible to changes in commodity prices. Okay, a natural hedge against these would be to take a short position on the Australian and Canadian dollars cross for the US dollars. Okay, because they're all net exporters and will enjoy an increase in commodity prices. Yeah, I'll put my Facebook on the end, guys. We'll have a couple of minutes to speak about that. Okay, so using stops. So stops, again, should be placed in proximity to the closest high for a short trade and next to the closest low for a long trade. So in essence, one needs to pinpoint the price level where the view of the reversal is kind of imminent. Okay. Really what that means is that we've identified the trend channel, okay? So we put our stops outside the trend channel, okay? So if we're looking for the market to break up higher, then our stops need to be below the level of support. And if it, again, be reasonable with your stops. If it breaks back 5 or 10 ticks, is that really enough to push you out the trade? But then again, you have to time with your risk reward. If it pushes back 20 ticks, yeah, the trade's probably wrong. But then that's what you have to decide. Maybe you only trade when the market moves into that trend channel. So if it does break out at any point, that's where your stop is. If it breaks the trend channel, you're wrong. Okay? So that's where you have to tie into your risk reward. And you have to tie in to, your view on the markets. So trailing stops. So trailing stops is probably the best way to put stops in when you're trading in a trend channel. Because we've already identified that when the trades are going well, we understand that we've got the direction of the market right. We understand the market's finding value for when it trades within these two ranges. So what we do is we put a trailing stop that if the market does retrace more than a certain percent or certain number of ticks, that we take our profit. Because remember, when you're trading within the trend channel, okay, you're only looking to put the stops in because you're already in profit. So you're protecting the profit you've already made. So again, it all depends on your risk strategy. It all depends on how confident you are, what your conviction for this particular trade is. Okay, so what I would do is that I'll put my trailing stop at a fixed percentage once the trade is on, because you know it's likely to go on side. And then maybe when you break past the midpoint, that becomes your stop. So then you've got all the room on the upside to play with and the possibility of a breakout to the upside. But if the market does come back, you're taking your profit at the midpoint. So limit orders. So limit orders are something that many traders find they can't do without. This doesn't mean that you can't put these in for your targets and that the target shouldn't be set. But again, it's another way of controlling your trades. If you know that you're 5 or 10 ticks away from the level of resistance, then maybe put some limit orders in already, take out half of your profit. So even if the market spikes back quickly, you've been filled and got out at a good point for profit. So that's another strategy you need to adopt, is putting your orders in ready to bank that profit when the market goes, because it can hit these levels of resistance, and as we've seen, move back very, very quickly. And the quicker it does that, the quicker it eats up your profit. So it's always an idea to have your orders in place to get out at that instant point. And then it's taking the stress out of the trade. Okay? It doesn't matter if the market breaks through, because you've already locked in some profit. So the market keeps going higher, you're still running half your position and making even more money. But you've banked that precious capital. Okay, so a bit of a summary when we're channel trading. We've identified our channel here, our level of resistance at the top, our midpoint, our level of support. We've seen our stop. We've drawn in a horizontal line where if the market breaks down below this, the channel doesn't work anymore. So we see the market moves up to the midpoint, bang, hits the level of resistance, we take profit. Hits the level of the midpoint, it breaks through, again, but it doesn't hit our level of support, so we buy back up. Again, we break through higher here, so even more profit to take. The market moves back into the trend, bang, we look to take out some profit at the midpoint or double up. Doesn't hit our level of support, but we've got all that area in which to take profit. And again, so we can identify 1, 2, 3, 4, 5 areas in that trend channel where we can buy, because again, it's a bullish sentiment, and make money. 1, 2, 3 really good points when the market breaks back into that trend, and we can take really good profits. All right, guys. Well, that's a summary of channel trading. Has anyone got any questions? We've got plenty of time to answer any questions people might have. Again, it's a strategy that you need to adopt, and it can be adopted to any market, but you have to make sure you tie in your own risk reward and your own trading strategy. This on its own is just a function. It's just a way of identifying a good entry point, an exit point, and going with the direction of the market. So you need to put your normal rules of risk reward in place when you're doing this. And again, you can overlay different oscillators, your MACD, your RSI, to kind of home your entry points. All these things you can look at. But it's a fairly simple technique that, again, when you do get it right, gives you all the confidence you need, because you've got your entry point, you've got your midpoint, you've got your exit point. So all you're doing when you're on side is looking for a point to take profit. And that's a powerful way of trading. Okay, and any questions, anything you guys would like to ask about channel trading or anything else? Okay, risk reward. Again, I love this question. Without seeing your trading plan, your trading style, I couldn't tell you what the correct risk reward is, but the standard ratio is 2 to 1. Try to make double what you staked, always. Okay, he said that I often trade 50-minute time frames. Yeah, I look at 50-minute time frames at entry points. Okay, but then once I'm on side, I'm quite happy to hold a trade for a couple of days, so I'll only go for the hourlies. So that's how I trade. I hold my entry point, I get on side, and then I look for my hourlies for my exit points. So, for instance, I've been short the S&P overnight. So I don't know where it is now. I'm guessing it's lower. Okay. We see a long up channel on the 4-hour euro, but decent sell-off the last 3 days. Time to buy soon or not? Well, again, that's what you need to look at, Terry. That's a great question. If you're looking at your 4 hours, then perhaps try and plot a channel or plot your trend lines against that, and then move down to your 15 minutes. Look for little candlestick patterns that could indicate when the market's due to turn, and then that's how you're going to get a good entry point. Okay, so I can't give you obviously financial advice. Are we going to see a big sell-off in the euro? I don't know, to be honest. The markets are just so unpredictable. But what I will say to you is, if you do identify from your 4 hours where the main trends are, if we do start to break through, they're going to be hit very quickly. The markets are due a fast-paced move. So again, what I would recommend to you is that we take that 3 days of data, we plot our channels on the highest time frames, or our support and resistance on the highest time frames we can, then move down and try and pick up little patterns, especially candlestick patterns in the 15 minutes, to look when the market's telling us it's due for a change. And that's when you should look at your entry point. Okay, how long do I look at charts during the day? It really does depend. I'd say I probably look at the charts, depending if I've got a position or not, every half an hour or so. Again, my kind of discipline is that once I'm in a position and I've got a view, I'd like to hold the trade for at least a few hours. So if I'm looking at 15-minute candles, I'd look for at least 3 hours. So I'd look at 12 candlestick formations to tell me I'm either still right or the market could be turning. That's how I look at it. I build up 15 minutes, then look at hours to see how that hourly is formed. Yeah, so that tells me my view is right or if the view of the market is changing. So that's how I trade. What do I do when I'm not trading? I speak to you. That's what I do. I hold webinars and walk the dog. So when do I know when your trade is wrong? Well, the main one is I'm offside. That's for generally when I know I'm wrong. But I think you really get a feeling when you're wrong. You don't feel comfortable. Okay, when I'm right, you can be a little bit kind of smug that you know where the market could, potentially could go to, and that's what I'm looking for. So I'm generally on side, and I'm feeling comfortable that I know that the candlestick formations are telling me that, again, if I'm looking to sell the market as I am the S&P now, then I look for tops, and then as long as I'm on side, I know the rest of the market are under pressure. Okay, there's not much good news coming out of Europe, so that the bias is going to be on the downside. So I just look for my levels on the downside to be hit. If they don't break up in a positive manner, they don't print any big green candles or any reversal patterns on the hourlies, or I don't see smaller reversal patterns forming on the 15 minutes, I stay short. I wait for the market to tell me that I'm wrong, because until it does, I will stay short and then look for a good place to take profit. So that's how I know. But then that comes with experience, Gold. It comes with just having looked at charts and having just been involved in the markets for so long. You get a sixth sense of these kind of things. But the main reason, the main indicator you're wrong is that you're either offside or you keep checking your charts, looking for information that isn't there. Yeah, when you feel nervous and you feel threatened, generally that's your mind telling you that the trade's wrong. And we all have this sixth sense, and we all have them feelings of doubt. And if you do have these feelings of doubt and you're not feeling comfortable, set out the trade or trade small size. No, don't put yourself in that negative frame of mind, that negative trading scenario, because it won't do you any good. Yeah, you want to be feeling confident. You want to know the market's going in your direction, and that's how you trade. That's the psychological side of trading that people don't invest in and don't get. And it's one of the most powerful lessons I've ever learned, is being true to your own convictions and being confident without being arrogant in your own trades. And that's what makes you a great trader, the ability to not feel comfortable, know you might be wrong, and sit out the trade. Yeah? If you do that once a month, I guarantee over a year you will save yourself a lot of money. But, yeah, great questions, guys. Brilliant. Anything else you'd like to ask? Anything that is on your mind? Any thoughts? Again, you can find me on Facebook. I'm Trader Maker on Facebook. What I'll do is, as always, I'll send you an email tomorrow morning after I get all your details of my up and coming webinars, and you can follow me. Again, I'm not one of these traders that likes to show off and brag that I've got the best strategy or I'm 100% off every time. That's not what I'm all about. I'm all about giving my experience and expertise to you guys and letting you go away into the markets and use it. Okay? That's all I want to do. I don't want to sell signals. I don't want any kind of accolade. I trade because I love it. I trade because to me, it's like work heroin. Why would you do anything else? So, again, I never charge for anything. I'll never ask you to hand over money. I just like you to turn up, ask intelligent questions, and go away in the market and hopefully be successful traders. The Facebook profile is Trader Maker. So Trader one word, Maker the other. Again, I'll put it on the link on the email. I'll send you all a nice email tomorrow with what I'm thinking, what I think is going to happen in the markets. Again, hopefully, great, brilliant. Cheers, Holly. Yeah, I am sincere. Again, that's why I'm very, very different than a lot of the speakers out there. Again, I'm not trying to profit off people, by selling information or signals. I very rarely talk about trading, to be honest. I like to talk about this theory. I like to talk about the psychology of trading, how I can give you guys the edge. Good question. How long did it take to get my sixth sense? And I knew about my sixth sense, and we all know about our sixth sense. How long did it take me to know I had that? No time at all. How long did it take me to listen to it? Years. Absolutely years. Because we all have that self-doubt. We all have that period of, I'll just ask my friend, or I'll just ask X trader or Y trader. It's, You have to listen to yourself. That's where the confidence of trading comes, by sticking to your plan, sticking to your beliefs, rightly or wrongly. Okay? Yeah, absolutely, yeah. Being able to open a position and wait, it requires a significant amount, yeah. But again, that's trading. There's no quick money, there's no easy money. That's just the way it goes, I'm afraid. Can I recommend a book that's helped me most in trading? To be honest, I've read most of them, and they're not very good. But it all depends what works for you. I read a lot of, again, when you read books about strategy and about trading, they generally cost a lot of money, and they generally tell you things you already know. So I don't really like to recommend books because I don't believe that they give you any real value. What I'd read is read the technical books, read the theory behind it, read things on psychology, things about mental strength. That's what you should be reading, because that's really trading. Trading is just numbers. It don't really matter what it is, So there's no real book I could recommend, to be honest. When I finish my book, funnily enough, which I'm going to publish for free, I'll send you a copy. Because again, I don't want to make money that way. The Facebook is Trader Maker. So Trader one word, Maker the other. You should see a picture of me. It's the same picture profile that I have on my FX Street page. Okay. Yeah, again, you have to use your sixth sense or your intuition. When people talk about a gut feeling, these are real things. Okay, it's not mumbo jumbo. It's not, Freud and psychology and that kind of stuff. When you're feeling good and you're trading well, you know it. Trading in the zone is just a made-up term that traders like to use because it's great. Yeah, I was in the zone. It's nonsense. When you're trading well, yeah, you're trading because you're looking at the right direction of the market, you're going with momentum, and you're making money. That's trading in the zone. That's all that is, being right. Yeah, when you're not in the zone, that's just all the other time of when the crazy madness of trading takes over. We get caught up in the noise. We say these words. Guys, how many times have you said this? I don't understand why the market's doing this. Why won't the market break? Why isn't it doing X, Y, and Z? Yeah? All that's saying is, I'm wrong. I'm wrong. I'm in the market, but I'm wrong. So what you need to do is quickly get out. Yeah? Get out and then wait for that feeling of when you're right. And trading becomes almost too easy. You think you're stealing money. But that's your sixth sense. That's the gut feeling you need. Okay, guys, anything else? Anything else you'd like to ask? Okay, great. Hopefully, remember, trading isn't simple. It's very difficult, and it takes a lot of personal investment in your education and how you manage your money. But it is inspiring. I love trading. I'm passionate about it. I dedicate a lot of my life to it. And that's how you need to feel. And that you need to treat trading as a privilege. It shouldn't be a chore, and it shouldn't be something that gets in the way of other things. It's just your opinions against other people's opinions, yeah, and knowing when you're right and staying with it, and knowing when you're wrong and knowing when to walk away. That's just the rules in life, the rules in anything. So that's the way I kind of look at trading. And when I'm not feeling it, I'm not feeling great, I don't go near that PC. When I'm feeling good and I'm feeling inspired, and I think I've got a view on the market, that's when I do get it. You don't have to sit for 12 hours a day behind a screen to make money. That can be counterproductive, guys. You need to take a break. You need other interests. And sometimes, you can not look at a graph for a day, then come back the next day and it's crystal clear. It's telling you, it's screaming at you what the market's going to do. And that's when you want to be involved. Not with the other times you look at a chart and you think, wow, I don't understand that chart. I don't understand why that happened. Good. Stay out. Run away. Okay. What would be a keyword or subject for mental strength? If you search in Google. Trading psychology. Try something like that. Again, I do other webinars on InterTrader, and there's a whole one on trading psychology. So if you open an account with InterTrader, you can listen to all my all my other webinars. Just go to tradermaker.com. All the information's on there, and you'll be able to speak to me, send me an email, and I'll help you. again, I hope as much as I can. I don't want to say too much, over this particular webinar because, we've got a set topic today. But if you go to my site, you can ask me any questions you want. My time's free. All right, guys. Well, I'm getting the nod that we need to let the next presenter come on. So it's been an absolute pleasure today, guys. You've asked some really good questions, and I really hope you've enjoyed it. I will be on FX Street in the coming month. I think maybe we're going to do advanced candlesticks or maybe trading with Elliot's Wave. So other interesting topics. And again, just Google Trader Maker. You'll be able to find me, and you'll be able to listen to this recording anyway. All right, guys. It's been an absolute pleasure. I'll hope to see you all very soon. Thanks more than the guys. Okay, good afternoon.